The Whale Playbook: How Elite Traders Control the Crypto Market. 1. The setup: was the crash really an accident? Every few years, crypto takes a nosedive, and everyone blames market sentiment. But what if that wasn't the full story? What if the crash was orchestrated, planned like a symphony of panic, by a handful of players with wallets fatter than national treasuries? So what does that actually mean? It means retail investors, the everyday traders, aren't losing because they're unlucky. They're losing because someone is pulling the strings. Crypto markets talk a big game about decentralization, yet behind the curtain lives a class of giants, whales. These entities, from exchanges to funds, can move markets with a single click. Their trades are invisible until they're not. The blockchain records every move, but by then, it's too late. Footnote: Whales, large holders of Bitcoin and other cryptocurrencies, possess market-shifting power, using timing and volume to influence global prices. 2. The players: who controls the ocean? Whales aren't mythical creatures, they're just rich and strategic. Membership in this not-so-exclusive club starts at roughly 1,000 Bitcoin. At today's value, that's over $100 million, small change if you're a hedge fund, life-changing if you're anyone else. Today's whales include early Bitcoin adopters, crypto exchanges, corporate treasuries, and institutional funds. Some are public. Most hide behind wallet addresses that look like someone fell asleep on the keyboard. The irony? The blockchain is transparent. Every transaction is there for the world to see, if you know how to read it. When a dormant wallet moves after 10 years, it's like spotting a sea monster, everyone panics. Footnote: Blockchain transparency reveals whale movement patterns, providing clues to market manipulation even when identity remains hidden. 3. The power moves: how to crash a market before breakfast. Markets move on liquidity. A single whale dumping 10,000 Bitcoin can slice through buy orders like a sword through paper. This triggers a cascade: forced liquidations, margin calls, and mass panic. That's not chaos, it's choreography. In August 2025, one whale offloaded over 24,000 Bitcoin in minutes, setting off a chain reaction worth over $500 million in losses. Then, once the panic hit its peak, they bought back cheaper. Efficient, cold-blooded, and completely legal. So what does that actually mean? It means the market isn't just volatile, it's manipulatively volatile. Footnote: Sudden large-scale Bitcoin sales often trigger automated sell-offs, magnifying short-term volatility and transferring wealth to initiators. 4. The subtle war: stop-loss hunts and illusions. Stop-losses are supposed to protect traders, but to whales, they're chum in the water. By pushing prices slightly below obvious support levels, they trigger cascading sell orders. Retail traders think they're safe, whales think they're predictable. Once the stops trigger, the price free falls. Whales buy the dip they created, smiling as the market rebounds. Then comes spoofing, a magic trick. Whales place enormous buy or sell orders they never intend to fill. This creates fake confidence or fear. Traders react. Then, right before execution, the whale cancels the order and trades the other direction. Wash trading is the encore: fake volume to create fake hype. In short, whales don't just trade assets, they trade emotions. Footnote: Stop-loss hunting and spoofing exploit human psychology, leveraging predictable trader behavior to engineer price swings. 5. The emotional battlefield: FUD and FOMO. Whales aren't just market players, they're storytellers. They spread fear, uncertainty, and doubt, FUD, when they want the price to drop. A rumor, a leak, a hint from a well-placed influencer, and retail investors start to panic. Prices fall, and the whales, conveniently, were short the entire time. Then comes the flip side: FOMO, or fear of missing out. Suddenly, influencers start shilling a new coin about to 100x. The whales quietly sell into the hysteria they created. The story drives the price, emotion drives the crowd. And once the music stops, only the whales are still dancing. Footnote. Market sentiment is engineered through emotional manipulation, where whales manufacture both panic and euphoria for strategic profit. 6. The case study, August 2025 flash crash. August 25, 2025. Bitcoin sits calm and steady. Then, boom, 24,000 Bitcoin sold in one brutal minute. Prices collapse, stop losses trigger, and $550 million in leveraged positions vanish. Within hours, headlines scream crypto bloodbath. Retail panic sells. Whales buy back in. But this time, institutions fight back. ETF arbitrage bots scoop up cheap Bitcoin, softening the blow. Still, the event exposes the pattern: dump, panic, profit. So what does that actually mean? The whales didn't just crash the market, they conducted a live stress test on everyone's nerves. Footnote. The 2025 crash illustrated a sophisticated blend of liquidity manipulation and psychological warfare, amplified by automated trading systems. 7. The counterattack: how to swim without getting eaten. So, what can small investors do? Simple. Stop being predictable. Don't park stop losses at obvious levels. Use alerts, not traps. Watch on-chain flows. Tools like Whale Alert and Glassnode give early warnings. If you see massive exchange inflows, brace for turbulence. Diversify. Avoid leverage like it's radioactive. And most importantly, zoom out. Don't chase every green candle or panic over every red wick. The whales thrive on emotional traders. Don't give them that satisfaction. Knowledge, discipline, and patience are the antidotes to manipulation. Footnote. Strategic awareness, emotional control, and database decision-making neutralize the majority of whale-driven market traps.